There we go. I guess maybe we'll give it another minute or two for folks to get in here. All right, we'll give it one more minute and we'll get started here. All right. So good evening, everyone. Thanks for taking some time out of your day to join us and listen to this exciting opportunity that we have in Universal City, Texas. It's sort of a northeastern suburb of San Antonio. First, I'm going to put a poll out there for you. Oh, this one needs to mute if you could. Just a quick poll gives us an idea of some topics that may be important to you and something we can touch upon during this webinar. So should be popping up on your side here now. You could just take a second and provide some feedback. That would be awesome. And on my side, it almost looks like the old school baseball stadium dot races. All right, we'll give it another couple seconds. And so looks like returns and track record are most important to the audience. So we'll obviously touch upon that here, and let's go ahead and get started here. So my name is Gabe Grzinski with Grzinski Capital. We have all the partner team is here on the call as well. We have Jad with B2B Capital, Dave Pinson with PFSF Investments, and then also from Grzinski Capital, my wife is in the background, and then Zach with PFSF is here as well. It'll be predominantly myself, Jad, and Dave sort of speaking here today. So I guess excuse me, since we're track record seems to be important. There we go. We'll go ahead and start off with that. I know Dave, Grzinski Capital and PFSF recently exited a property here in Texas. Actually purchased that in November of 2020. Sold it, I believe that was closed on that in April, May. So in the course of 18 months, we were able to over double investor money, investor capital and on an IRR basis, that was 72% IRR. Obviously, that's not the norm, but that is a deal that we did recently exit. I know there are some other properties that are in the process of closing and going through refinance. Dave or Jad, do you want to speak to potentially any of those?
Yeah, absolutely. Jad here. Welcome everyone. Thanks for joining us. We cross paths quite a bit, Gabe and I, in the Texas market, and we have a few ongoing projects. But a lot of our exited projects have been up north. We've got recently finished earlier this year a larger project in Fenton in Michigan. We've done projects in Ohio. The most recent exits have been the ones in Michigan. A lot of the projects that are currently in front of you on the slide are either recently exited or majority are in progress, currently in the works. A little bit over 1,000 doors, and a lot of it is very similar in terms of multifamily value add, some sort of rent increase component, and in terms of the returns, they're typically in the 20% range, which is what we're seeing. And then specific to Michigan and the most recent exit, it was a bit of a shorter timeline, which definitely helps on the returns when looking at the IRR, but that one's in close to the 30% range. So it's a bit on us, and I know from a call it experience perspective, there's great talent here on the board between Gabe, some of our background in the management space, as well as Dave, who will speak on this, but they have a very impressive background as well, and with everything they're doing in property as well as asset management. So, Dave, I'll let you take it from here.
Yeah, absolutely. Thanks, Jad. Thanks, Gabe. Appreciate all of you joining us tonight. My partner Zach and I represent PFSF Investments, and I'm also the president and CEO of Trinity Multifamily, a third-party management company based out of Fort Smith. Zach and myself with PFSF have either co-GP, co-sponsored, partnered on well over 2,000 units and almost a dozen states. Some of them do overlap with Jad's here. I see several on the list that we have partnered on, and so far have disposed of 3 of those assets to date, including the one Gabe just mentioned, and have realized and recognized some very good returns. So the group definitely has the track record to push this deal across the finish line.
Awesome. So I guess while we're at it, let's go ahead and do some quick intros and backgrounds. Jad, if you want to start off.
Yeah, absolutely. Just as we spoke on the portfolio side of things and being active in multiple markets, but started out in the real estate brokerage property management world, built out a property management and construction firm in the Cleveland market, which has really brought a lot of kind of day-to-day experience into the asset management that we're doing today in the larger projects, right? So we're able to see nowadays if there are certain metrics that the on-the-ground team is seeing that they're providing us on our weekly calls, weekly asset management. We're able to see a lot of that and see through it because we've built these companies and have the experience of operating, whether locally or now many projects nationwide as well. We're in between. We're over 1,000 doors today. We're in between multiple states, and as far as our operations go, it's a mix of asset management, what we're doing here on the investment side, as well as construction and improving the projects that we're taking on, and really that's our niche. We've got a few other businesses as well in the mix, but most of our time is really full go real estate, property management, investments, and asset management.
Awesome. So Gabe Grzinski here. Our background, my wife and I spent, I guess probably between the two of us, three plus decades in corporate America. My background is in program and construction management, working on large scale, multi-million-dollar telecom projects. And then, we've spent, I guess, going on 5 years now real estate, and then within just earlier this year went full-time real estate. Left my W-2 to focus solely on real estate, and in that time we also had just here this month officially launched a debt and institutional equity brokerage. So that's sort of my I guess forte or niches in analyzing deals and finding good opportunities. So Sherry, do you want to sort of speak a little to your background?
Sure. Thanks, Gabe. Yeah, I spent 10 years in the corporate world, focusing mostly on project management, contracts, and pricing negotiations with suppliers, mostly in the telecom industry. And I am a real estate broker here in Texas, and I also focus on real estate marketing, strategy, and lead generation.
Awesome. Now we'll turn it over to Mr. Pinson.
Hey, appreciate it, Gabe. Dave Pinson here, President and CEO of Trinity. It's a host of different real estate companies that primarily focuses on property management, construction management, due diligence. We do some brokerage. And then also Zach Smithson and I co-founded PFSF Investments that I mentioned earlier, and have done a couple thousand units through co-GPing and partnerships. And we also have a large commercial roofing and construction company as well.
Awesome. And I don't know if Zach, if you're on and want to speak, or where you can.
I am on here, but I don't have to talk. I think y'all have already said everything there is to say for me. I'm not that interesting.
Okay. Hey, no worries.
He's just the roofer, so we're good.
Yeah.
All right. So I guess I'll sort of get started as to the property and give you an idea of why we like it. So one of the first things that we look at that's part of our buying criteria is crime, the crime rate in an area, and then schools, and then from there we sort of if it passes that sniff test, then we'll look at it a little bit, dive into it a little bit more. And what we like about this property is we use a service that sort of grades crime based on local police data and FBI crime data as well. And this area is in an A-, B+ area as far as the grading goes. So if you look at a crime map of San Antonio, you really want to be sort of in the suburbs, and especially more especially in the northeastern quadrant. And so that's where we are in crime. And then on the schools, we look at what most people probably look at, or at least they're familiar with on Zillow is greatschools.org. And we want to make sure that the schools are at least average or above average, because traditionally the properties that we're looking at are have a higher percentage of 2 and 3 bedrooms, which means that there's going to be more families living there, and we want to ensure that those families have a safe place to live, as well as good schools for their kids to go to. That generally equates to them staying longer, and a longer tenant that stays longer is good for us. It costs a lot of money to find new tenants, and then update units. So we like to have tenants that stay there long. And on that note, we do have one tenant there that I think has been living there at least 13 years. During due diligence, we've found that. So and then obviously we want to look at the economy. San Antonio has a great economy, and then population growth. And this is right on the border of I know a lot of Texans call it Bear. It's spelled Bexar County, but it's right on the border of that county, and then the two of the top 5 fastest growing counties in the state of Texas, which are located between San Antonio and Austin. And those counties are growing at a rate between 5 and 10% year over year. So you know, a lot of population growth, good schools, great economy. You know, this San Antonio also had what was ranked number 1 in jobs, paying over 6-figure job growth of 6-figure jobs between 2015 and 2020. So just another reason that we like it. You know, here's some just some exterior photos of the property. It's a nice little garden style community. You know, there's great retail nearby, some, you know, Starbucks, Chick-fil-A's, Target, stuff that you want to see near a property that you would want to live in. So here, you know, this just gives you sort of an idea of what rent is in the area. All these numbers are well above what the I think average of, yeah, our average rents between all units is $920 a month, and you'll see there isn't a single average $920 on here, and this is all within just a few mile radius of the property. So so our rents are well below market, and we didn't underwrite with super aggressive growth. And we're still below these average and median figures on here in our projections, and we didn't factor in CoStar and Axiometrics, which are two of the industry leading services that provide sort of data for multifamily. They're projecting, I think CoStar is at 10%, and Axiometrics is in between 12 and 15% rent growth for this area. So, but we did not underwrite for that in year 1. So, yeah, the property is, you know, it's a 44 unit property, currently 98% occupied. That's sort of another testament to where the rents are. And generally, if you're above 95% occupancy rate, it's probably because you're below market. It's sort of, I don't know if we need to, do we have the returns here? So I know I'll sort of speak to the returns basically trying to go off the top of my head. So we'll use $100,000 as a, you know, just a number to use. So per $100,000 invested, you should expect another $100,000 within 5 years. So you'll get just a little over $200,000 total. And you know, during that time period, I know we have a 7% preferred return. You know, that we're going to be a little bit shy of that number. But you know, if for any money that's not paid on a quarterly basis, that should be paid off that 7%, that money will be accrued and paid at the end. So you know, we would expect for $100,000 investment, you'll probably see somewhere between probably $500 and $600 to $6,500 a year, and then you know that gets paid quarterly. So sort of split that in fours, and that's what you would expect to see. You know, as far as you know, for those that can utilize it. For cost segregation, there will be depreciation that can be taken especially for real estate professionals, you know, and other folks can utilize it as well. Just you know, you would want to speak with your CPA, but we would expect to see for a K1 issued year 1 somewhere between probably it's going to fall in between 50 and 60% of your investment will be, you'll be able to write that off year one with a K1 that will be sent. And I think the total depreciation amount over the course of 5 years is somewhere in the high, just shy of 70%. I think I hit that stuff. Property management, Dave, you want to sort of give a little bit about property management and asset management, and then I can throw in my 2 cents.
Absolutely. Some of you on the call may have heard my intro or read my bio and see that I own a large property management company that manages 20,000 doors in more than 15 states. And you may be asking yourself, well, why did the group pick GBT Property Management to manage the asset and not Trinity Multifamily, since Dave's involved in the deal? And GBT Property Management is a Texas-based company that focuses and specializes on assets of this type. While Trinity will manage and does manage assets of this type, we primarily focus on 100 unit plus assets. GBT Property Management does have a relationship with some of these sponsors and do have a proven track record in the state of Texas, and moreover in the San Antonio MSA. Trinity Multifamily in this will provide the asset management services and be available to assist with any construction related items, construction management related items, review of reports, review of monthly financials, and a second set of eyes on the property.
Yeah, and I'll chime in real quick. So we actually use GBT for a property that we own in the panhandle of Texas, which is, as far as Texas goes, that's about as remote as it gets. It might as well be Colorado at that point, but it is very, very remote, and they manage it remotely and do a fantastic job. And we basically used a bridge loan to purchase this property, and we're able to refinance out within 6 months, and that's sort of a testament to the record keeping and them being able to lease the property up, and our value, the value went up probably 2.5 times within 6-8 months time. So they know what they're doing, and that's what we like. So some more representative pictures of the interior. Not all the units have the fancy blue doors, but a few of them do. I'm really not sure about the color choice, but hey, it works. So you'll see it's nice, pretty nice units. Let's go over sort of some of the track record again. Jad, do you want to, since this is yours, you want to sort of speak to this a little more?
Yeah, absolutely. This is an early 2020 acquisition, right? So this is very similar sized complex, slightly bigger, a little bit more than 44 doors. But this is up north in the Michigan market, and the entire project was a bit more of a value add, a bit more of a construction lift compared to a more of a management play here, which we were briefly talking about the market, and Gabe, thank you for breaking down the returns here. But I wanted to sort of kind of reiterate some of the stuff that you mentioned, just because they're really valuable and make this deal so special. So we were able to accomplish great results in Michigan, and that was mainly a value add construction, asset management improvements, building improvements. And why I'm excited about the new project here is because, although we are able to improve the asset management, it's a great setup because there's a out-of-town owner that has a part-time manager currently in place. So the amount of improved quality and condition at the property in terms of, for the residents, as well as from an asset management standpoint, and our ability to pay a lot more attention to the property, improve it, is vastly there. And then, if we're able to do something like this in Michigan with very flat population increases, Where we're at in Universal City is essentially it's on the borders. It's 20 minutes from downtown San Antonio. It's an hour from downtown Austin, where there's rents are $3,000-4,000 a month. But the population growth in this market is very impressive. It's the fastest growing couple counties here, fastest growing counties in the United States, Texas. And so if we can replicate but now we factor in that we're also going to be in a growing market that has even better economics, that makes us feel a lot more exciting. So a bit on the track record here, really this was a project that was not as well occupied. And so it was a slightly tougher project to get to the 95% occupancy. It took a lot of construction and new tenant placement in order to get to these numbers that you're seeing on the screen here. And then again, what makes Universal City so exciting is the fact that the project is already in a great state, has high occupancy, so it's a much easier play and a much easier execution for us to get it to produce the results we're looking for. And then from a results perspective, we are really using conservative underwriting, conservative rents. We're in the 1,030 to 1,050 a month, kind of what we're projecting. But just based off of today's current comps in the market, there are anywhere between studios at $900 and 3 bedrooms at $1,600. So we're already above that 920 limit of where it is today on a monthly basis. And that still does not factor in the fact that San Antonio as a whole, and this region between San Antonio and Austin, is expecting another 10 to 15% population growth, job growth, as well as Axiometrics has somewhere around 13% for 2022 in terms of rent growth projections. It's actually been a little bit higher. So since last year, June, it's been closer to 15.25% increase in rent. So we want to apply the same, improvements that we've done on these previous projects, the asset management, our expertise. Everybody, the entire team brings a great skill set, and we want to apply it to this project. But it's kind of cool because we have this additional advantage that in this market is important, which is the growth, the population increase, the rent increase, which is typically outside of our control in terms of controlling the exterior market. We control what we do at the property level. But then when we factor in these additional exciting factors about the market, what we did here in Fenton and what the guys have done on the previous project in Texas should be very easily replicated and doable in this project here. So I guess that's a bit on that previous project.
Yeah, I would agree, and something that I don't think we really touched upon that, but is probably something that folks may be thinking about is the debt and the interest rate that we're getting here. So I'll sort of speak to that. We have secured long-term fixed rate debt from Freddie Mac. So our interest rate is under 5%, and it's a five-year term, and the reason we did that is historically speaking, the Fed rates, they generally increase rates in this type of environment, in an inflationary environment, anywhere between the average is about 2 years, and I think the longest historically speaking is just a little over 3 years. So we wanted to make sure that we were on the backside of those sort of choppier rate environments, for a sale or refinance. And then I guess another thing that I just looking over data here in the past week, the Fed actually starts to drop rates within 6 to 12 months of a recession. So we expect to I think the writing is on the wall, and it'll probably be made official here in about within I guess by the end of the month. So, that's the reason why we wanted to ensure that we secured fixed longer term debt. I've seen a lot of folks that do more shorter term floating rate debt, and for certain projects that works great, but this obviously doesn't make sense in this scenario. So that's a little bit about the debt. Let's see. Yeah, I think that's about it. I don't know if we missed anything. If anyone has any questions, feel free to type it in the chat, and we can answer that. Dave, Jad, did I miss anything?
No, we did a great job. I would say we won the property in the bids at a lower price point than other bidders. From day one, we're getting a discount on the price. We're getting some built-in equity, and that's usually a track record or a terms advantage. And so the seller chose to work with us, although we offered lower than some of the other buyers. But that's great, and that speaks to the values in the market. That speaks to the value that we're buying this at. And then, that still doesn't include the fact that it's already worth more than it is when we're buying at the price point we're buying it. It's already worth more than that. But it also doesn't factor in the fact that there is 15% rent growth happening. There is a lot of room for us to improve management. There is an out-of-state owner that is poorly managing or not optimally managing, I should say. And so there's really a lot of growth here. And then I would say the only other thing, and Gabe, thanks for mentioning the interest rate and kind of speaking around the economy here. The best hedge is usually a good location and growth. And so if there's any place to be in real estate currently, it would be in a landlord friendly market like Texas, but also in the fastest growing region in the entire in the entire state. And so there's a lot of beneficial factors that are the value add piece. And then from day one, it's already bought at a discount compared to what other bidders are willing to buy it at. And so it's a great hedge. It's a great play compared to, a lot of other markets currently, but also just a lot of other investment opportunities. I think being in real estate with long-term fixed debt, sub 5%, with the growth that's happening here, I just think overall there's a lot of really good, healthy components that should make this a great success. I know Gabe touched up on the numbers and the returns. So if anybody has any questions, feel free to throw them in the chat as well. But of course, with all this growth, we want to maximize on it. And as the operating team, we'll make sure to make the most of it and, shoot for the stars, essentially, shoot for great returns as much as the market allows. So we'll do our job as far as the operation of the building, and then anywhere where we can see opportunities to increase the profitability and the returns to the investors, we will. And being in a great market, it makes our job a lot easier. That's that on the market, the valuation, buying it at a discount from day one. There's a lot of great factors here. It's a very, very nice location to be in.
Let me speak to another question that just came in. So, we spoke to really the rent increases on the value add component, but there are other aspects, obviously, that will be, able to help add value there. So one of those is reserved covered parking. That is currently at $10 a month, and the market average is at least 25. So, we will be, on lease renewals, we will be updating that to $25 a month. Same with pets. we are they're at $10 a month for pet rent, and market is 25. And then we're also looking to implement some on-site sort of storage. We have 2 basically big storage rooms that are unutilized currently, and looking to sort of build those out and then rent those for minimum at least $50 a month. It'll probably run somewhere closer to $70 a month. So that's three additional items that are sort of low hanging fruit, in addition to the rent growth there. Also see a question about time frame and closing on the fund. So ideally, we would like to have documents reviewed and signed sometime this week, early next week, and then funding by the probably the end of next week ideally. We may be able to slip into the following week, but the property is set to close basically the first week of August. So
Yeah, I think we said up until the 22nd might be kind of like the cutoff.
yeah, that is correct. So how often do you guys update investors? All right, let me read this here. In addition to for someone who's new, is there an opportunity gains? Oh yes. So a question was asked, how often do we update investors, and especially during the sort of the initial phase where we're starting to update units, implement some of the additional fees or increased fees. We'll be updating investors probably, I would say at least probably monthly the first let's say 6 months. Then after that, it's generally going to be sort of quarterly. And yes, we can certainly help educate why we're doing things and sort of how we're doing things. I think that was another question that was asked. Another one here: who pays utilities? So utilities, electric is paid by the tenant, and then water and sewer is paid by the owner, but it is billed back to the tenants. And that was another area where that we can increase the percentage or the amount that's billed back to the tenants slightly, so that will also help with the increase in value. I know we put up a poll earlier about folks that have been to San Antonio, so I looked like there were a number of you all that had been there, so that's good. It's always nice to know where you're investing in, and obviously you're getting to know who you're investing in. The team on the call here, and I think yes, you will have access to this. This is actually in the investor portal. Shira, can you paste that link in the chat when you have a chance?
Sure.
But I'll that data, and as well as some other supporting documents, something that goes over sort of the economy and employment and stuff is all in this portal, so you'll have access to that. I guess I think I may have one more poll for everyone. Oops, I've got one last poll. And should be on your screen now.
Oh, I've been waiting on this one.
And if there are any other questions, feel free to ask, or if you think of something after the call, reach out to one of us. We're available, and we can jump on a call or a Zoom, or send it via email. We're definitely available.
On the screen, you have my cell phone number is right on the screen there as well. So any questions? I know if you do have specific questions that are, maybe not, you don't want to share on the chat here, or maybe want to dive into something a little bit deeper, we're happy to help in that regard. We can set up a phone call. You can reach us, all of us, by text. We can do a video call if there's anything to show, and to dive into more specifics. But in general, we're here to answer any questions. We're here to help, even as the project develops and comes along. There's the monthly updates, but we're always around to assist and make sure that the investor experience is where it needs to be. And then, we look forward to questions, partnerships, many investments for the many that have invested before, as well as many new relationships and investments to some of the folks that maybe their first time. And those usually are the exciting ones, and we look forward to forging a lot of that. So thanks for joining us today. Gabe, I'll leave it with you, and Dave from here.
Thank you, everyone. We appreciate it.
Oh yeah, let me add this investor link. Yeah, it's okay. So someone else asked, what does build back to the tenant mean? So basically, and it's either done by a flat fee when you're billing back utilities, or it's it's called a ratio utility billing system. So you can bill, and Dave, maybe you should speak to this, because I don't want to say anything wrong, but basically you can bill up to a certain percentage of your water and sewer bill back to tenants, and it's usually based on bedrooms, the number of people that are living there, in bathrooms. So but
it's state specific and algorithm based. It's based on square footage, number of occupants, and number of bathrooms, and there's opportunity there as well for us to continue to maximize income and monthly reoccurring billing.
all right. Well, if that's it, I appreciate everyone that joined, and we'll be sending out a recording as well. I don't know if it'll be this evening or first thing tomorrow morning. All right.
Fantastic. Thank you guys very much. You all have a great one.
All right. Thanks, everyone.